Hello, everyone. Welcome to our webinar on rebalancing your investment portfolio in turbulent market conditions. So I'll start by introducing our two speakers, who is Nahashon Mungai and Jesse, who are going to also have a moment to talk to you. But before that's just some ground rules. Let's ensure that all our questions are typed on the chat function so that we're able to answer them during the Q&A section. So we'll have a robust Q&A section. So those who've enabled their mics and their videos, please relax. We are going to have time for that and we'll be able to engage. So I'll take this over to Nahashon to lead us in the introduction, and then we can start. Thank you.
Thank you very much, Victor. And thank you to all the participants and attendees of today's webinar. So my name is Nahashon Mungai. I'm the Executive Director for Global Markets here at Standard Investment Bank. And today we'll be discussing how we can rebalance your investment portfolio in turbulent market conditions. We've had concerns from some of our clients, both existing and potential clients, asking us how we can help them to manage the potential risks around the concerns for the second half of this year, and also to discuss how our fund, which is Mansa X, has performed in the first half of this year. Most of the times when I do these webinars, I do them alone, but today we'll have Jesse James Arua, who's one of the portfolio managers as well in the Global Markets Department. So he'll be helping me to talk to you today. So without much further ado, let me begin. I hope everyone can see my presentation. I'll very quickly start by introducing our Standard Investment Bank. Standard Investment Bank is one of Kenya's largest indigenous investment banks. In fact, it was founded in 1995. So we are about 27 years old in this market with about 850 million shillings worth of company capital. That's about more than 3 times the regulatory minimum, which is 250 million shillings. But on top of that, we manage about 20 billion shillings worth of funds, whether from our equity side of the business or our fund, our biggest fund, which is Mansa X. We are members of the NSC, which is a Nairobi Stock Exchange, CDSC, Central Depository and Settlements Corporation. We're also members of the Kenya Association of Stockbrokers and Investment Banks. And our client base includes government, fund managers, corporations, financial institutions, high net worth individuals, and retail investors. Our milestones, as I mentioned earlier, we were founded in 1995 as Standard Stocks, and it was in 2003, so about 8 years later, that we got our investment banking license to be registered as Standard Investment Bank. And since then, we've had several milestones, including being awarded Best Investment Bank, being awarded Best Stockbroker through several awards. And we're very proud of some of the transactions we have done locally, including the largest transactions the largest transaction to ever be done in the capital markets, which is advising KenGen with their 28 billion shillings rights issue. We've also done several other advisory businesses, which I will show you later. In 2018, at the tail end of it, we were licensed to be the first online Forex money manager. And it's from this license that we created the product Mansa X. And at the time, we were the only money managers for this product until just earlier this year. And in 2019, we were able to register the highest return for a regulated fund manager at that time, which was a 24% annualized rate of return. As SIB, our products include equities, fixed income, corporate finance, research, and global markets. So on the equity side, we trade in company stocks and derivatives. If you're looking to buy or sell shares, you come to us and we'll help you to do this. If you're looking to buy government bonds or invest in government bonds and you do not know how to do this, we can help you through our fixed income desk. And for this fixed income aspect of it, we do not only just the local government bonds, but we are also the one place you can come to trade Euro bonds, and we can help you understand how you can actually get into the Eurobond market as well. We have a corporate finance division where we have worked with Kenya's largest public and private institutions to help them inform their strategic growth, help them with balance sheet restructuring, capital raising, and balance sheet management. We have a very strong research department as well. And from here, we're able to churn out reports that help you to understand what's happening in the equity markets, fixed income markets, and also what's happening in the private business space. Global Markets Department is one of the newest one. Okay, we need to stop calling it new now because we've been doing it for more than 4 years now. But this one helps you through our Global Markets Department, we're able to offer our clients exposure to global financial instruments, such as the world's major currencies, precious metals, commodities, global stock indices, and selected single stocks from around the world. We're able to do this through some of the products I will explain later, but also through this global markets division. And this is something that's very important during this period of concerns around currency depreciation. We also offer very strong FX, which is Forex hedging solutions to our clients, both corporate and retail. So highlights of SIB. So far, we have successfully advised over 60 project transactions worth over 200 billion shillings. This is through IPOs, bond issuances, private placements, like I mentioned earlier, the 25 billion public infrastructure bond offer that was done by the Kenyan. We've also done rights issues for several companies, spanning from financial services to banking, insurance, aviation, utilities, and hospitality. We've advised on takeovers and mergers. Most of the mergers you've heard about, or takeovers, for example, Kennel being taken over by Rubis and so on, we have actually advised on this. Business valuations, we have also helped to do this, and we're able to do this even from a very private perspective. So if you're looking for corporate finance guidance, whether it's in your private business or in your any other type of business, even from a government perspective, SIB is really the place to come to, and we can help you with this advisory work. So in front of you, I have put tombstones of the many transactions we have done just to show you the proficiency that we have. I will not go into any of them, mostly because of the time that we have today. We only have an hour for today's presentation, and I would really like for us to spend most of the time today just answering the questions from most of you. So I'll moving on. So let me introduce Mansa X. What is Mansa X? Some of you are already our clients, so you have been our clients for a long time, so you know what Mansa X is. But for those who don't know, X is a multi-asset strategy fund with a long-short trading model that invests in financial instruments, both local and global. The primary objective of creating capital growth for its investors. So that's a very important definition. Multi-asset strategy meaning invest in several assets, which is a key defining aspect of our fund. The fact that we are a fully diversified fund, and we really spread out the investments that we receive from our clients. And I had mentioned earlier, we were the first money manager licensed by the Capital Markets Authority to engage in this type of business. Our fund profile is the minimum investment is 250,000 shillings. Minimum top up is 100,000 shillings. We have a lock-in period, a recommended lock-in period of 6 months. We have a financial services charge, meaning that we charge you 5% per annum for our services, but we prorate this over the period of your investment on a daily prorated arrangement. Our custodian is I&M Bank, and one of the biggest advantages of the fund is that we're very liquid, meaning that if you wanted to access your funds, because of the nature of the asset classes that we invest in, you're able to access your funds within a very short period, typically between 2 to 3 working days. How long it takes is a factor of sometimes even just the bank that you use as our client. We currently manage, that figure is as at 31st of March 2022, so it needs to be updated, but we currently manage almost 10 billion shillings of investor funds. So where does your money go when you invest with us? It goes into several places. I'll go through them. The first place is stock indices. So stock indices is essentially just buying an entire stock, an amalgamation of stocks, and then, with an expectation that this stock indices, this stock index will move in a particular direction, whether up or down. So we are talking about, for example, the New York Stock Exchange, S&P 500, the FTSE, and so on, German DAX. We also invest in single stocks. Single stocks is just individual shares in around the world. We invest in commodities, for example, oil and natural gas. We invest in precious metals. Think of gold, think of silver. Currencies, most of the major world currencies, whether it's the G10 currencies like the euro, the yen, the dollar, Swiss franc, or whether it's emerging market currencies like the South African rand or the Turkish lira, or frontier market currencies like ours. We trade in all these currencies. We also trade in derivatives of all types. So derivatives are essentially instruments that gain their value from an underlying asset class. So typically, for example, forward transactions, swap transactions, option trading, and so on. Those are the derivatives that we trade on behalf of our clients. We also happen to hold a lot of cash. This is important. It keeps the fund liquid and also helps us to take advantage of opportunities as they arise. So we also hold cash and cash equivalents. That's an asset for us. Fixed income, meaning we invest in debt instruments, typically sovereign debt issued by governments around the world, whether it's our local government bonds, African Euro bonds, US treasuries, German bonds, and so on. That's our fixed income asset class. We also trade in our local stock exchange equities, including also on the derivatives exchange. And we also trade in exchange traded funds. Exchange traded funds are very similar to indices in that it's really an amalgamation of stocks in a particular sectors, which are then lumped together and bought or sold as one unit. What are the advantages of the fund? The first one, of course, is diversification. A lot of people are concerned about how do we get the return that you do without increasing our risk. The reason why we give a higher return is actually mostly because we're very well diversified, meaning that you're gaining an advantage from each and every single asset class that we have put your money in. The fact that we can access several markets at the same time, this is very important. Nairobi is actually very well strategically placed in terms of accessing various markets within an 8-hour working day, meaning that during a one day in Nairobi, we can access London markets, New York markets, and Tokyo markets in one day, which makes it very interesting to trade from Nairobi. And from this, we're able to give a very interesting return to our clients and exposure to those markets. Another advantage we have is because a lot of our asset classes will be invested in foreign currency, mostly the dollar. We're able to give a much higher return because over time, the dollar has tended to strengthen against the local currency. So this has augmented the return that we give our clients. Leverage, the ability to trade higher than we have actually received from our clients, meaning that we are essentially almost working with borrowed funds. This helps us to augment the return. So every dollar I receive, I can get a return of $10 out of that. That in itself helps me to have an advantage in terms of the return that I can give our clients. Of course, this comes with, it's a double-edged sword, meaning that the reverse is also true, which means that the risk management that we apply here is also a lot more complex than a typical fund. Trading opportunities, meaning that our fund, when I mentioned earlier that we are a long-short trading fund, means that whether markets are rising or they're losing value, we can find trading opportunities in all those. And that's how we are also able to, again, compound the returns that we can give our clients. Liquidity, as I mentioned earlier, the ability to easily access your funds from Mansa X is one of our biggest advantages because from when we started this fund, one of the things that we really wanted to do was to give clients a good return while still allowing them to access their funds as and when they needed their funds. But this is not a very easy compromise because typically when your returns are higher, then you tend to be in more illiquid assets and vice versa. But at Mansa X, we've managed to find a sweet spot where we can give a good return while still not compromising the liquidity that we provide you. Another advantage which should not be overlooked is just the fact that we are locally based. We are able to give you all these advantages, which you typically have to go to foreign markets to access. And we are still based locally. You know where our offices are. You can come visit us. You can come have a conversation with our financial advisors or you can come have a conversation even with us, and we will be able to explain to you exactly what we are doing with your money and how best maybe even to diversify your portfolio. So this is one of the advantages as well that we have created through this product, Mansa X. How have we performed this year? So far, and this return is an annualized return, just for clarity. We have given a return of 15.9% after our fees. So this is our net return, and we still feel that this return is above average compared to what you could possibly receive out there, and it continues to be proof of our concept. So what you have in front of you there is really just the quarterly performance since the fund started. So for the last 2 quarters, those are the last 2 bars on that graph. You have in Q1, we returned 3.8% and we returned 4.13% in the last quarter. So since the fund started, we've offered an average return of 4.37%. That's just about almost 17.5% since the fund was started, which again, we feel that has really proved the concept of diversification as a good tool to increase our average returns. So what's in front of you, just a very simple demonstration of how your funds would have performed had you invested with us from the start. So let's say from start of 2019 to now. So an investor who had invested $1 million with us would have 1.8 million shillings as their capital right now after fees as at the end of the last half of the year. So you can see it's quite a significant growth for a disciplined investor who has kept their funds inside Mansa X. How does this compare to the rest of investments out there? Government bonds compared to fixed income deposits, maybe if you put your money in a SACCO or other money market funds out there, you can see Mansa X still manages to make a higher return than all of those instruments. And it's not just the return, and again, I emphasize the fact that it's not just the return that's very interesting here, it's also the fact that it's a very well diversified product and also a very liquid product. So I will now leave it up to Jesse to just give you a summary of how the fund performed in the first half of this year and what asset classes led to that performance. Over to you, Jesse.
Hello, good afternoon, everyone. Yes, my name is Jesse James Arua, portfolio manager here at Standard Investment Bank. So we started the year already on the back foot of rising inflation worries all over the world. We saw in the US, inflation as of end of last year was just under 7%, which was already an over 20-year high, and something that we knew the Fed would not tolerate for much longer. And as the year has progressed, we currently see inflation in the US at 9.1%, while in Europe, inflation stood at just under 5% as of December 2021, and currently it's at 8.6%. So again, emphasizing the need for central banks to come in and act on this to prevent it escalating even further. And because of that, we suspected that markets would be turbulent as interest rates would have to be raised, and this would affect a lot of business and companies, how they operate all over. However, what we did not anticipate was the invasion of Russia by invasion of Ukraine by Russia, and this again supercharged a situation that was already teetering on the edge, enabling a lot of volatility in the markets, as we saw the Nasdaq dropping to 30%, over 30% over the year, over the course of the first half of the year, while the S&P 500 also dropped by over 22% for the first 6 months of the year. And this also led to a number of opportunities in the markets that we managed to take advantage of. Yeah. So During the first half of the year, we managed. At first, we saw that food would be an interesting opportunity given the drought that was occurring in most of the major producing countries of wheat and corn, such as Brazil, Argentina, Russia. So we already anticipated that there would be a situation in the food space, and as such focused a lot of our plays on the commodity space. And already when Russia invaded Ukraine, that brought the numbers even higher than what we had expected, with wheat gaining over 30% in the first quarter. And by quarter two, it actually dropped by 12%. However, this only happened during the last month of the quarter, with the earlier 2 months of quarter two having seen it rise by over 70%, given what happened with Ukraine. And we saw the same situation play out with corn, whereby corn gained about 26% over the course of the first quarter. And in Q2, during the last month, we saw it drop by 16%. However, it had also gained another 15% at the start of Q2. So these were very interesting and interesting times for us because they provided opportunities that we anticipated. Another thing that, because of rising interest rates, that we're able to take advantage of would be technology companies, because rising interest rates affects their valuations. Yeah, so we saw a lot of technology companies being affected the most over the course of the first half of the year due to rising interest rates. And we saw companies such as PayPal dropping over 50% for the first half of the year, and Netflix dropping over 60% during the first 6 months of the year in valuations. And this was another advantage of Mansa X, being that we are a long short trading model. We're able to take advantage of these short opportunities. We also were able to make money from currencies. Given the strength of the dollar due to the Fed's aggressive rise in interest rates, we saw the dollar gain quite significantly against most of the major currencies in the world. We saw it drop by 15. We saw the yen lose value by 15% against the dollar. We saw the euro lose about 10% during the first half of the year. And we saw the pound drop also almost 10% during the first half of the year. And this led to some very interesting currency plays on our part as short opportunities for them while we were long the dollar. Yeah.
Thank you, Jesse. I hope that helps you to get some color on how the fund is actually able to squeeze out a return, even during such turbulent times as what we've witnessed in the first half of this year. And in fact, the kind of volatility we saw in the first half was reminiscent of what we saw during the pandemic. It was just as intense, and mostly because of the geopolitical tensions. So what do we expect moving into the second half? A lot of our clients have been asking us whether their funds are safe in the second half of the year, whether we're well positioned to give them the same kind of returns that they have come to depend from us. So I'll just give you the key highlights of what we expect in the second half of the year, and be very clear that this is an expectation, but we feel that this helps to sum up based on the kind of research you've done internally. Of course, the first thing we'll discuss are the elections and whether the elections will have an impact on returns. But I can quickly just tell you off the top of my head, and not really, and I'll explain why very shortly. The next concern is what a lot of clients have been asking us, whether we're going to have any recession globally. Are we moving into a global recession? Are we due for a recession? And if so, what is Mansa X doing to protect our money? Second question is around geopolitical tensions. Do we expect this to continue? And if so, how does this affect the portfolio? And on our side, we'll also be very keen on watching company earnings, especially for the US companies of whom we hold significant positions. So on the elections, let's discuss myth versus reality on investing during elections in Kenya. That chart in front of you shows the stock market performance. This is for the NSE All Share Index for the last 10 years. So from 1st of January 2012 to this year, January, you'll see that the last elections we had in 2013, you can see the stock market actually gained during that year and continued to gain all the way to 2015. The next time we had elections and we had any concerns around them was in 2017. And again, if you look at that chart, in fact, the drop in the stock market was between 2015 and 2017. This was not during an election period. Then during 2017, again, you see a bit of flattening, but then again, a rise in those markets. So we feel and argue that markets locally have not really been affected by elections as much as a lot of observers like to point that out as a concern for performance in the local stock market. So this year, we don't expect that to be different. In fact, a lot of factors that affect our local stock market have nothing to do with what's happening locally. Typically, for example, in 2020, during the pandemic, that affected the performance of markets, as you see a lot of foreign investors avoiding to take on risk. That's because a big portion of our stock market, contains as much as 70%, is traded by foreign investors. Again, this year, because of the concerns around geopolitical tensions, we saw a bit of a dip in the markets. Again, not because of what's happening locally, but because of what's happening globally. So this is just to help with that myth versus reality of how markets locally perform against, during election periods. Now back to the question about recession. A lot of people have asked us this question, so we felt like it's important to deal with this as much as we can. So we'll start by defining what a recession is. So a recession is typically described as what happens if an economy goes through two negative quarterly readings of the GDP numbers. So if you have a negative GDP number, for example, in Q1, then a negative GDP number in Q2, then you're officially in a recession. That's typically the old-fashioned way of very summarily explaining what a recession is. Now, a lot of people will then argue, aren't we therefore, or rather, is in the US in a recession because you had negative 1.6% growth in GDP in Q1, and just recently they printed the data for the second quarter, which was again at negative 0.9. So typically that should be a recession. And I guess that's what all market participants, that's what we all accepted, defines a recession as, and therefore we all agree the US is in a recession. But we saw the White House come out with a statement, which we here at Mansa tend to agree with, and I'll explain why. So this is actually paraphrased from a White House statement, which came out last quarter, saying that, for example, while some maintain that 2 consecutive quarters of falling real GDP constitute a recession, that is neither the official definition nor the way economists evaluate the state of the business cycle. So you see that kind of refutes what I had said earlier. Instead, both official determinations of recessions and economists' assessment of economic activity are based on a holistic look at the data, including the labor market, consumer and business spending, industrial production, and incomes. Based on this data, it is unlikely that the decline in the GDP in the first quarter of this year, even if followed by another GDP decline in the second quarter, indicates a recession. So essentially what the White House was trying to say is that we should not take 2 negative prints of GDP as a recession because the other numbers are still positive. And just to show you the other numbers, for example, unemployment is actually down only 3.6% in the last half compared to more than 5% last year this time. So that already shows you that the labor numbers are actually not bad. We also have we've also added, or rather the US added about 372,000 jobs last month alone. So again, this shows you that we are not really in a recession. But moving forward, I guess what we'll be looking at are those jobs numbers. We'll be looking at factory productions, and we'll also be looking at consumer sentiment. But just speaking about consumer sentiment, we are actually at the lowest level of consumer sentiment since the pandemic. So again, we will still be looking at that. So the other thing we'll be looking at, just back to our list here, is the geopolitical tensions. Do we then expect continued tensions between Russia and Ukraine? Yes. And what are the impacts of this? So the first impact is the fact that it can create a food crisis. We saw concerns around distribution of corn and wheat around the world from Ukraine as Russia continue to bombard Ukrainian ports. We expect that this will be a concern moving forward, and this can create inflationary pressures in emerging markets, including most economies in Africa, even our own. We import a lot of our wheat from Ukraine. So this is expected to continue to be a concern. The other concern is that it also creates, we already had a problem with supply chain constraints because of the Chinese zero tolerance on COVID. They have now changed this to a dynamic COVID policy, but we still expect that concerns around geopolitical tensions will continue to create supply chain constraints, which tends to put upward pressure on inflation. And because of this, we will still continue to have concerns around how the central banks will react to this. Now, still on geopolitical tensions, the other thing that's now slowly brewing under the surface is really just tensions between the US and China. We have seen, for example, today, everybody's waiting to see whether Nancy Pelosi is going to land in Taiwan, which is a big concern for the Chinese, and they have been very clear that they will take that as some sort of act of aggression. And this sort of rhetoric coming from all these world major economies creates a certain tension, which is not very good for markets generally. So with this, we will be watching with a lot of concern in the second half of this year. The other thing that we'll be watching, of course, will be central bank actions around the world. We saw the European Central Bank finally increase the interest rates by 50 basis points. We'll be expecting see more action from there. From the US side, we saw them as well increase by another 75 basis points. Now we are closer to 2.5%, 2.5 to 2.75 band. So moving forward, we still expect that central bank actions will really determine the action of markets. Company earnings, we're watching company earnings very closely because this will help us to determine whether we have seen a bottom in some of these markets. Are we going to see a V-shaped correction, or are we going to see a continuation of some of the bearish moves we saw earlier in the year? Of course, right now, because a lot of technology companies have the highest margins, they have disproportionate sizes in most of the indices that we look at, for example, NASDAQ and S&P. And based on this, we will be watching their company earnings, mostly because also of the impact of dollar strength. Right now, we are seeing globally, the dollar has strengthened against most currencies. And for example, for the first time in 20 years, the euro traded at parity with the dollar. Now, what this tends to do, because most US companies, 45% of their income tends to actually be based outside the US, this tends to affect their earnings. And we saw that recently. Most major companies that we've been watching here at Mansa X in our portfolios, whether long or short, missed their earnings. Such companies such as Alphabet, we saw Microsoft miss their earnings, we saw Coca-Cola miss their earnings. And most of these companies will continue to miss their earnings if the dollar continues to strengthen. And this therefore becomes one of the things that we'll be looking at very closely in the second half of the year to see whether the returns will be affected, or rather how the markets will recover. But moving forward, we still feel that in spite of all this turbulence, the fact that you have a portfolio that is in all these asset classes in the first place should still keep our investors very well protected, both from missing out on a return, and also most importantly, from ending up with a downside risk. So we are still monitoring all this. We still feel that the fund is very well diversified to handle this. A lot of the commodities that we have been trading have also continued to give very good returns. We are still giving our clients exposure to commodities such as natural gas, and those tend to be very predictable in terms of their movements because they are really just based on demand and supply. And again, these have continued to help our clients make a return, and we feel that this will continue into the second half of this year. We'll also be watching interest rates, both locally and globally. I think the biggest local play right now is really just in the Eurobond space. As recent as about 15 days ago, we were investing and buying Eurobonds at around 21% yield, and that's for the Kenya 2024 paper. And these kind of yields have really helped to augment our client returns as well, because we are really talking about very high yields, again, in a dollar-denominated assets. Since then, the yields have continued to come off. We expect them to come off as a matter of two factors. One, election risk being having less weighting in a lot of portfolio managers' concerns, and also increased participation in the Eurobond trading space by local investors. We expect, again, that this will keep interest rates subdued, at least for the next half of the year. So it should be very a lucrative space for fund managers who are trading in that space. And we again have been really at the forefront of investing in Eurobonds for our investors. Globally, interest rates have come down somewhat. We saw a high of 3.5 for the US 10s and almost 2% for the German bonds. Ever since, we have seen them drop almost 100 basis points. But we still expect that there will be some pressure on the yields. And for this reason, we'll continue to look for opportunities to trade that volatility, number one, and two, to look for opportunities to short US treasuries and German bonds. So for the second half of the quarter, we still expect that Mansa X should still be able to deliver the kind of return our clients have come to expect as we continue to take advantage of all these moving parts, which I have highlighted, and any more that might come up unexpectedly, as tends to happen in markets such as ours. So Victor, over to you.
So thanks a lot, Nashan. I believe that this is a section that most of us are really waiting for. So we're going to go straight to Q&As. Please continue typing your questions on the chat function so that we can be able to respond to all the questions that you might have. So the first question, Nashan, what's your view on cryptocurrency as an investment option? I think this question has come before.
Yes. Well, we've actually been asked this question very many times before, and at Mansa X, we've always been very emphatic that we have never viewed cryptocurrency as an asset class, because how do you find, there has to be, let's first define what an asset is. An asset is something that has an intrinsic value, meaning that without buying or selling it, there's actually some value that you gain out of it. And where does that intrinsic value come from? Either you can use it in the production of something. For example, gold, you can use it in the production of jewelry or electronics or whatever. Or it gives you future cash flows. For example, when you buy a bond or you hold currency, you can actually receive interest rates, which is now the value of that asset class over time. That's what gives it value. But we feel that with cryptocurrencies, the value of that asset class is really just based on the next party willing to pay a higher price for it than you paid for it. So it's called a greater fool theory in economics. And based on that reason, we have always maintained that we don't view investing in cryptocurrencies as a good idea. Yeah, because we are not a commercial bank. We don't give fixed deposits. But again, the indicative in the market around maybe 6 to 8% for most fixed deposits. Depends on the amount that you're investing in as well. So banks have bands that they will use. So it's not just the period that you're investing in, it's also the amount that you're investing in. But typically 6 to 8 for now. But these tend to change over time. Number one. Number two, they are dependent on the liquidity of the bank that's quoting that fixed deposit rate. So this will change from commercial bank to commercial
And maybe if the question was referring to if this investor had put in money in Mansa X, using an example of £1 million shillings, the return for the first half of 2022 was 7.93. So at least you're able to see that that comes to around what, 79,300 if you'd invested for 6 months working with £1 million shillings. For the first 6 months of the year. So the return varies quarter on quarter, so it's not going to be fixed. When you look at our rates from last year, as we've indicated on the slides that we showed, the quarter on quarter performance, you'll see that it changes quarter on quarter. So I think next one by Ivan James, can you indicate the fixed income products available to retail investors? It's okay. We can be able to share that with you. Maybe you can drop your email on the chat, and then we'll be able to share that. Yes, I think these are concerned. We hardly cover that a lot on our presentations, but you can have that included for next time, James. So the next question, can you indicate, sorry, this is Stephen Kamau. Please shed light on how two clients having invested in Mansa X at the same time and equal cash received different returns with the same period of time. I think Mahashan.
So first, to answer that question, we'd have to verify that data, whether actually they invested the same amount and whether they actually invested at the same exact time, same exact amount, because even 2-3 days difference in investing in the fund can give very significantly amounts, returns. So it's very important to first define whether that's actually the case. And you can take this up with our customer service team. And I think, Victor, maybe if you take the email address of the concerned client, we can have that conversation separately.
So Stephen, please leave your email behind with us so that now you can be able to pick that up and be able to address it at that level. The next question by Bernardo Onsongo is a return of 15.9% net of withholding tax.
Thank you for your question. We've been asked this question many times about the taxes. So within the product itself, we trade in instruments that pay withholding tax, whether it's bank deposits or fixed income instruments. Those are the two main asset classes where we pay withholding tax. Other asset classes, we pay other taxes such as VAT, for example, on most of our brokerage fees. So within the fund, we pay those taxes. Now, our fund is what you call a market determined return, meaning that it's not a guaranteed return. For this reason, withholding tax would actually not apply to our fund as a whole, as a return in its whole. But as an individual, if you're given your tax returns, you can declare it as an income. And now how the taxman would then apply it would then be as a market determined return, which has already paid most of these taxes. But we can, and this is something that we have also asked our regulator to clarify for us, is from their perspective, what tax bracket does Mansa X fall into? But from what we know, there should be no tax, because a few years ago, you had capital gains tax. So capital gains tax would have taxed you if you had a higher, if you gained a profit or you had a gain in your portfolio versus maybe the previous year, then you'd get charged a capital gains tax. But this capital gains tax was scrapped for capital market. So to answer your question, we already paid the withholding tax for you, so you have no withholding tax that you need to pay, and there's no capital gains tax on capital markets products. But again, as it comes to tax matters, it's always good to talk to your tax advisor.
Thanks a lot, Mahashan. I know that we might have emerging questions from that. So guys, don't be afraid. You can continue asking your questions. We'll be here to answer them. So Mutua Mutuku wants to know, what has led to the decline in the returns from 24% that you once offered? Is the trend looking up or down?
Oh, okay. I guess that's a difficult question to answer. Markets have been different. We had a very tough period of COVID, and during such periods, something called cash drag tends to happen. What does this mean? When you go into periods of very high turbulence and very high volatility, or a lot of uncertainty in the first place, it's only prudent that a fund manager keeps a lot of the portfolio in cash. This is both to protect the downside for the client, as well as to create, to have the ability to use cash as and when opportunities arise. But this creates something called a cash drag, meaning that because that cash is not in the most highly performing assets, during that period, the return dips somewhat. So a lower return is really just also a demonstration of what happened during that pandemic period. And that is when I'm sure you probably noticed some concerns around those returns. But we feel that now we're getting out of it and we're getting into more exuberant time in the markets and with more predictable volatility. Because sometimes you have volatility that's unpredictable. Volatility we saw with the pandemic, when we would not know whether we were in lockdown or not, or whether lockdown would be canceled or not. That created what you call unpredictable volatility. But right now, we are sort of able to know market direction or predict generally better because it's around geopolitical tensions and central bank actions, which are a lot easier to predict based on historical behaviors in markets. So to answer your question, we still feel optimistic that the fund will continue to perform well. Just recently, you saw, we've had conversations like this before with our investors, and they've asked us, how come we always have lower returns in the second quarter of the year? And I've always told them it's really fast because you have lower liquidity in markets, and then also just purely coincidence. So the last 2 years, we had pandemic concerns around the exact same periods when Q2 happened. But you saw how just last quarter, when you had a much more different environment where we were only dealing with central bank actions and geopolitical tensions, we then had a second quarter that even gave a higher return than the first quarter of this year. So all these things tend to be different, but Mutuku just have confidence that the fund is expected to continue to do well in spite of what happens.
Thanks for that, Nash. Jackie, 2 questions in one. First one, how have you handled the current liquidity crisis and non-functional interbank in the FX market? And then attached to that, how do you also cover me as a client if I invest in foreign currency, since I will need to purchase hard currency?
Well, that's a good question. We have seen unprecedented lack of liquidity in dollars in the market, mostly because panics such as those tend to also be self-reinforcing, meaning that the more people are concerned that there's a liquidity, the more they hold and the more they create augment that liquidity crisis. Have we been able to handle this? We have very good relationships with most local banks. Since we started this fund, we created a lot of what you call counterparty trading lines with most of our local banks. If you notice, a lot of our product base is actually derivatives, meaning we have gotten into derivative contracts with a lot of banks, allowing us to have seen ahead and being able to have some of these products like dollars in our reserves. So we've not really been affected as maybe someone on the streets would have been affected. We have been able to have very well liquid, and we have been able to have the kind of dollars we require to take positions in the markets that we trade. To explain how some of these derivatives work, if I have an excess in shillings and I need dollars, I can actually give out shillings and receive dollars, only to receive them or give them back a year from now. That's what you call a swap transaction. And we're able to get into such contracts with banks, allowing us to never have a problem with our dollar liquidity within our fund. And again, some of these products are very, very unique to Mansa X. We've been able to create products such as those to protect our clients. And again, this has continued to serve us very well. The second question, meaning if you had invested in dollars and you needed to then withdraw in dollars, maybe after a period of time, reach out to us. We can create hedging solutions for you. If you remember, during my introduction of the fund, I mentioned that we have hedging solutions for investors. We've always had a minimum for this sort of hedging solution, however, which is $100,000, mostly because when we enter into such hedging solutions, we also have to do what you call covering in the interbank market with other institutions. And there's a bare minimum that you can actually trade. But for our investors, we're always willing to bend over backwards for you. So if you have such a concern, please reach out to your relationship manager or financial advisor, and we'll get back to you with a response on that.
Thanks on that, Nash. Next question, Arnold. With the Federal Reserve increasing interest rates on the USD, there's talk of inflation and a possible market crash in the US. So how have you covered this position? Jesse? Okay.
Hi, so as you've seen from our trading model, we are a long short fund, which means that we do whatever our view changes from market is going to go up to when we see that there's going to be a dip in the market, we do take positions on the other side of the trade, expecting that prices will fall. Again, with interest rates going up, there are opportunities from this. For instance, the USD gaining and strengthening is a function of them having high and the Federal Reserve being more aggressive than other central banks around the world. And this has led to the USD gaining all across against almost all currencies in the world. And we're able to take advantage of this by being on that side of the trade. Another thing that we are able to do at Mansa X, because we also have a long-term view of the market. If a year ago we were bullish on certain companies like Apple and Alphabet, Microsoft, etc., right now with the decreased valuations, we're able to slowly start to build out our long-term book in terms of the companies that we really like to come out of this period in a better position. And that's how we're able to do it at Mansa X.
Okay. Thanks a lot, Jesse. So we move on to Fred Mutua. I believe you answered that question about, can you comment on the declining quarterly returns last 3 years vis-a-vis growth in the AUM? We say that these are primarily market determined funds, so we not necessarily be able to book and say that this is the return fixed that you're going to get from the fund. So, but then when you look at quarter on quarter, you'll definitely see upward mobility and maybe some slight decline in some quarters.
And sorry to cut you short there, Victor. It's actually very important for investors to be very cautionary about fund managers who give you guaranteed returns no matter how markets perform. It's just not reasonable. And you should be very suspicious if markets are, markets are turbulent, or there's change in volatility of markets, is changing the uncertainty in markets, and your fund manager still insists on claiming that they can give you a certain guaranteed return. At Mansa X, we trade the best we can to give you a certain return, but this can shift over time. But over the long run, we expect that will still be the average return. And we feel that that's a much more representative way of trading rather than giving you a more almost fraudulent view of how markets actually work.
Thank you, Nashon. Bernard Onsongo, what's your comment on capital preservation, and what guarantee do I have that I won't lose part of my capital? In a practical example, have you had any capital depreciation? Nashon?
I think that just goes to what I was just saying. But, well, we do our best to manage your funds well. And to answer your question, no, we have been fortunate never to have had a negative return for our investors. But to answer your questions, markets do actually come with risk. And it's important for investors to understand this. It's the same thing, going back to what I just said earlier. If you have a fund manager who tells you that there are no risks in markets and nothing can happen to anything you invest with us, that's not realistic. That is not how markets behave. The only thing you can get from a fund manager is very optimal management of your funds, proper risk management, such that at any one time, your capital is preserved, not because markets are safe, but because their risk management systems are good enough to handle the turbulence and volatility of those markets, which I believe is what we have here at Mansa X.
Thanks, Nash. Lumi Aboka, yes, we'll share the clip with you at the end of the session once we have the edited version. And then Carol Mwanzia, I think Nashon has answered this question severally now. So Mutua Mutuku, do you offer a minimum guaranteed return on Mansa X? No, we don't. I don't know if Nashon, you want to comment? Yeah. So the answer is no, we don't offer minimum guaranteed return on Mansa X. And then Caroline Riungu, this is a bit, I think, administrative, operational. If an investor has 2 accounts having invested at different times? Is it possible to merge two accounts? Would I get more returns when I lump the money together? We might have to look at that from an operations perspective, because if you are holding two separate accounts, yes, it's possible to maybe withdraw funds from one account and now add it to have it moved to the other account. Does this mean that you'll get more returns? Not necessarily. Not necessarily. Yeah. Okay. So Caroline, again, we'd be interested in taking this again offsite, because it looks like something that is affecting you in the fund. So I would like to take this up and be able to resolve it. So please, you can leave behind your email address, and then we'll reach out to you. And then Sarah Mugo, what was the return this quarter? So the last quarter, I think you mean last quarter, quarter two, the absolute return was 4.13% net. That's what we delivered for last quarter. And then what is the timeline for improvements in yields on Euro bonds? Yeah. What is the timeline for improvement in yields on Euro bonds?
I don't know what you mean by improvements, because in our world, improvement in yields actually means dropping if you had already invested. So if you had bought Euro bonds and they're losing value, then for us, that's actually an improvement in yields. But I'm guessing you mean them rising, which you already saw. Like I mentioned, last month we had yields as high as 21% on the Kenyan 24 paper. We've had yields as high as 25% for some of the Ghanaian Euro bonds. We have seen also very high rates for Angolan Euro bonds and so on. Every day we give an outlook on what we expect Euro bonds to be trading at and how we expect them to fare in the short to medium term. If you'd like to be receiving this information or you'd want some guidance on this, again, this is something that falls under our Global Markets Department, and we are more than happy to offer you guidance on how you can take advantage of these movements in Euro bonds as well. But to answer your question, yields go up and down, and this happens sometimes in a matter of weeks. But a lot of the reason why yields had gone up was concerns around the Federal Reserve raising interest rates higher than expected, and two, concerns around even just restructuring of debt by the Kenyan government, which we think was overplayed. The third one was concerns around elections and whether this will have an impact on this economy. Again, we think that's overplayed. So that caused interest rates to Eurobond interest rates to rise to unprecedented levels. But we are now seeing a correction in that. From highs of 21, we are now trading back to levels of 12 to 13% as of today. So you can see that was very short-lived.
So the next, Sarah Mugo, I love Mansa X.
Thank you.
Thank you so much. We hope to continue delivering the best to you. Eunice Kinyanji, grateful to Naashon for the enlightening presentation. Thanks a lot, Eunice. And then Teresia Wanjiku. Teresia Wanjiku, what is the process of investing in Mansa X? So the process, once you fill in the forms, so ideally once we have your contact information, we'll send you a couple of forms which you'll be able to fill in, and then you send them back to us with the requisite KYC. We'll be able to open an investment account for you locally, and then issue you with account funding details. After funding the account, then you're up and running. So it typically takes less than a day for you to be able to be ready to go. So Teresia, you can leave us your email address so that we reach out and send you the forms to get you started. And then apart from the markets that you have invested in and you shared here, how has the Ukraine war really affected the local Kenyan economy for markets? Naashon?
Yes, so like I mentioned earlier, of course, food prices have gone up, and concerns around that, uncertainty about whether you can actually receive your shipments of wheat when you expected to receive this. This will cause and has continued to cause a rise in wheat prices. So of course, it's caused uncertainties around food security, and this will continue to be a concern. Because if you are an importer of wheat now, you don't know whether your shipment will arrive when you expected it to. And again, this again starts creating more insecurity for other countries as well, of whom we depend on. For example, just recently we saw Indonesia again does not want to export their palm oil in the way that they used to, because of what they are seeing happening there. So every country now is becoming defensive, and this will definitely affect us locally. I guess maybe moving forward, it's for the government to take more action. I mean, to put a lot more resources in making sure that we produce a lot of these foods locally, as opposed to depending on foreign countries. But yes, there's definitely an impact, definitely. So expect food prices to be higher, which again leads to inflation. So you have inflationary pressures. This can lead to the central bank again increasing interest rates, which will make life more expensive for everybody. Just recently, we had a monetary policy committee meeting just last week. The CBK never increased interest rates, but if we continue to see such pressures on inflation, right now Kenyan inflation is at 8.3, which is actually lower, for example, than the US, which is at 9.1. But we expect that if we continue getting this kind of pressures, it can cause us to need to adjust interest rates, which obviously is not good for the population.
Thanks a lot, Anshin. So Henry Waruhio, in rebalancing the asset classes in H2 2022, what is your proposed portfolio mix? It's very specific.
Yeah. So, Henry, thank you for the question. We do not currently, this is a discretionary fund, first of all. So what we do here is on a day-to-day, a week-to-week basis, we look at what our view is of the markets, where we see the opportunity lies in the short term, in the medium term, and in the long term, and we tend to weigh our allocation of funds based on where we see the opportunity is. And so I can't give you an exact mix because, again, we're data dependent. If the US job numbers, for instance, which are being announced this coming Friday, come out negative, that changes our view of what we think will happen going forward. So any asset class mix that I would give you right now would also be rendered invalid. So I don't know how best to do this, but just know that that's what we do here. We try to look at what the data is telling us, where we think things are headed, and that's where we try to allocate our funds in the best mix possible. Yeah.
Thank you so much, Jesse. We are winding down, so I'm seeing a question from Jackie on crypto. So I think we've covered that for now. Should something change in relation to the regulation, then maybe we'll be able to discuss more. Andrew Mecca, why is the statement not cumulative or auditable? You can't tell how much more to add or grow. Andrew, I believe that depends on how the statement was generated. So you can reach out to your relationship manager so that they can be able to generate for you your statement from your start date. You'll see all the transactions that are involved. I think at the moment when you send quarterly statements for clients who want to see specifically what they made for the quarter, that's why you will see that you don't have a lot of data from the previous quarter. It's just a balance carried forward. But we should be able to sort that out for you because the data is available. Mary Mbugwa, conversation on the fact that, or the feeling that the return has been declining. Like we said, Mansa X does not fix a rate, so we are market determined. So I believe Nashon has covered that at length. And then SP, if I have a USD bank account, can I invest with USD and receive my interest in USD? Yes, that's possible. Nashon has said, so long as you have the minimum amount of $100,000. And then next one, as an investor, can I request more of my funds to go in a particular asset? Like you said, no, because just like you've been told, Mansa X is a discretionary fund, so you're not able to fix and say that this is what I want to my money to be invested in. So so no. And then Moses Mutwa, if you invest one name as an individual and also one name as a corporate for the same day and the period, what would make an earning in both cases different? Again, for Moses, I want to be able to take this with you so that we can be able to look at this specific scenario and respond to your question adequately. Expound more on lock-in period. We have a lock-in period of 6 months. Within this period, it's highly recommended that investors not withdraw their capital or part of their capital, just to be able to give us enough time to trade and give you a return. But should you have an emergency, you have that provision, you'll be allowed to access your funds, only that it negates the reason why you're investing in the first place. So I believe lock-in period is just to be able to enable us give you a good return for at least that minimum period. Sheila, if Mansa X is earning returns in USD above 30%, how come the return to the client is 15% in shillings net? Seems if I invest directly into some of the asset classes mentioned, like Apple, Microsoft, returns on short-term or daily trades are incredible. I think it's Nashan.
Well, that's a factor of the fact that the fund, as you can see, we don't invest the whole fund in just those asset classes. We don't take. I remember when I showed you the asset allocation of this fund. I don't know if it's here. I tried to demonstrate that we invest in very many asset classes. So we invest almost 10 billion shillings of your funds. We don't take 30% of that fund and put it in Apple and the other 70% in 2 or 3 other stocks. If we did that, we probably might mirror those performances of those asset classes that we talked about. But there's also something else that would happen to your money. You'd go through periods of immense volatility of returns, sometimes with downside risks of even up to 50%. Now, that would not be a prudent way to manage your funds. So sometimes our funds are invested in those asset classes, but sometimes they're also in cash and cash equivalent assets, which yield a lot lower. So you're talking about Apple, for example, rising 30%, but on this other hand, we can have a 10-year paper yield in only 10%. It's a balance of these asset classes that goes and feeds into the eventual return of about 17%. And that is why your return is not as exceptional as you imagine if you were just investing one of those few asset classes. Because if you pick some of those asset classes, the returns would be significant. I mean, if you took Tesla stock last year, for example, it gained over 700%. So one can argue, why did Mansa at least do 500% return? But the argument again is on that diversification, including risk management techniques that are used internally, limiting the amount of funds that can be placed in any one asset class. And that's why when you come to a fund like ours, one of the risk management tools that we use are things like having an investment committee overseeing the fund, working within limits that we have already filed with the CMA through our investment policy statement, for example. And all those things, again, play into that return. So it's not as radical as just getting into one highly performing asset and squeezing a return out of that. That would be very imprudent.
Thank you so much, Nashan. So we'll take only 3 more and then we are done. So Lumia Boka, I know you're not able to invest for a week or 2. That's not the fund profile. So we discourage you from doing that. You should just come invest at a time when you have the time to be able to invest within the fund features or the profile of the fund. Does Mansa X protect against capital erosion, and how are funds protected from possible market shocks and volatility? Think something around our risk management, which Nashan had already covered. So I believe that's sufficient. And then are you planning to invest in other sectors like construction of houses for sale?
No, we are not. We are not planning to do that. Okay. We are very keen on investing in liquid assets, and at the moment we are not in any development plans.
So the next question to you, Nashan, what's your opinion on the portfolios held in local stocks and bonds with current change of political regimes in the country? Has the fund ensured our seed capital investment?
Well, even with a change in political landscape, of course, company earnings can be affected if an economy suffers because of poor politics. Of course, that is always a concern for any investor. It's a reason why sometimes stocks can fall in value, especially if you expect an unfavorable regime to take over. That's always a concern. Going to things like government debt, again, that's a concern. But any government, good or bad, depends on thriving capital markets to stay in power. Because again, they still need companies to pay their taxes to keep them in power. For this reason, we feel that this remains a very good reason for them to be very careful about how they market, like capital markets, especially debt and equity markets. And that's why, irrespective of which regime has been in power, they have tended to perform fairly the same. We expect this not to change, but it's a legitimate concern. But we feel that Kenya, especially because of where it's positioned on the continent and how the other economies surrounding us also depend on us handling our economy in the right way, we feel that capital markets still have a long way to go, and we feel like there's more upside than downside moving forward.
Thanks, Nashon. So before I give the final question, maybe I can see some questions that are more operational around our statements. Our statements are quarterly for you to be able to just have that trend in your statements. Yes, of course, it's different from the likes of CIC. And then someone wants us to share financial reports as at 30th June 2023. That's okay. We can be able to share all the financials that you require, because these are usually published on newspapers. We've been publishing since the fund began. We've been publishing that, and then please share financials on Mansa X. That's okay. And then what else? I think that's sufficient. So the question to you, Nashon, will the launch of the Nairobi International Financial Center have any bearing on local or offshore investments from Mansa X?
Yes, of course, we are very excited about it. First, because it allows a lot of foreign investor participation in our markets. We've already been seeing that participation. We expect that this will increase, mostly also because there are tax incentives around that. It also increases business in areas such as custody businesses, clearing businesses, which of course, again, is good for capital markets, both from a point of revenue, but also from a point of increasing human resource growth. So we're very excited about it. From Mansa X, how is that relevant? It helps us also to just grow, because as a fund, if we're in an environment like this, we're also able to attract foreign investors, which again is good for the fund, helps us also with managing our foreign currency reserves. So it's something that we're very excited about, and we are very keen to be keen participants, to be significant participants and supporters of.
Thanks a lot, Nashon. I think that brings us to the end of our forum. We can see there's so many other questions which we'd love to take up with all those who've asked offline. We have our email address, clientservices@sib.co.ke, because I've seen a lot of questions from investors which are touching on the operational side of the business, which we can be able to address in real time. So please ensure that you drop us that email should you have any concerns around your investments, your statements, and then we'll be able to address them right when you raise them, so that now you don't need to wait when we have our webinar, because we feel like that is very urgent and we need to handle it with the urgency that it deserves. So I think I will take it back to Nashon to just give his closing remarks, as well as Jesse, and then now we can call it a day.
Hello, thank you everyone for joining us in this webinar. We appreciate the questions and your interest in the fund. We do not take it lightly, the trust that you have in us to provide you with the service that we do. So thank you again, and see you guys next time.
All right, thank you everybody for being part of this webinar today. And we've noticed and we've seen that you have a lot of questions for us. We're very happy, because it shows that you're actively engaged and invested in being part of us. And we hope that moving forward, we continue to prove to you that this kind of fund is very important to be part of your portfolio. We continue to reinforce the fact that a fund like this helps you to really manage how you have spread out your returns and how you also manage your liquidity. It's also very important as investors to be concerned about the ability to receive your money when you need it. And that's one of the things that we've also helped, and that's one of the things we have designed our fund to be able to do. So the second half of the quarter, we look forward to giving you even better returns and even better value for your money. And we look forward to more webinars like this, Victor. If you can arrange for even more webinars like this, based on the number of questions we are seeing today, it tells us that we probably need to have as many sessions as possible so that we can answer all the concerns from investors. But thank you all and have a nice evening.